A niche call out is the private debt markets. This is another expansionary area of credit that's been extended, I think really in response to the regulation of the banking system. Two things to note here. Number one, there's a significant amount of dry powder sitting on the sidelines, which I think is going to continue to chase deals aggressively, likely at tighter spreads, also likely with a more aggressive companies, creating more effective leverage and risk in the economy. So that's point number one. And point number two, for funds that invest in this private debt market, the deregulation that Mark talked about earlier, we think is going to continue to drive down returns, making it more and more challenging for those guys to achieve the target return expectations that they've advertised to their investors. The final point I would make on the private debt markets is sort of its faux lack of volatility. Most of those funds are held at cost until there's otherwise a problem in the portfolios. And we think that a lot of investors are reliant upon that 7% consistent rate of return that's been advertised. But when we do get into a cycle, we think that's going to be a risk to the cycle, but B, an opportunity set for folks that are ready to take advantage of it.
I see that point firsthand. We manage a BDC that's healthcare focused, and we felt that to counterbalance some of these trends, if you specialize, you can uniquely underwrite assets, and that's proven to be quite successful. But when we see circumstances where others come into the healthcare space, the underwriting discipline tends to be very lax, and there's a chase for yield to the point where people are doing unwise deals in order to attain a mid-single digit yield, and on the back end have almost no operational and workout capability to take the keys of the business and resurrect it if it hits the skids. So at the same time that money's flowing aggressively into the space, there's a lot of reckless activity. So it is an interesting disconnect.